Well, today, we're stripping away the flashy marketing. We are going to look at the cold, hard math of wealth building to do a comprehensive comparison between these two financial heavyweights. So let's dive right in by anchoring our story with a very tangible starting line, $50,000. Now, why 50 grand? Because it's a huge financial milestone for any investor. It's enough capital to generate some serious momentum, but honestly, one wrong move, it can set you back an entire decade. We're going to take this exact 50 grand and follow two entirely different investment paths over a 20-year journey. We want to see exactly how wealth is actually built, and maybe more importantly, what it really costs you. Right out the gate, we have a stark contrast in lifestyle between our two paths. On one side, we've got the landlord route. Buying a rental property is visible, it's tangible, and yeah, it's pretty socially impressive. You can physically drive past it, point to it, and tell your friends at a weekend barbecue, hey, I own that. Facing off against this is the index fund path. This one is completely invisible and, let's be honest, often considered incredibly boring. You set up an automatic monthly transfer, and when people ask what you invest in, you say, broad market funds. They'll usually just nod, casually check their watch, and change the subject before they die of boredom. But here's the thing. That early feeling of having a tangible investment often completely masks the long-term price of maintaining it. Let's start with the reality of real estate, because we really need to ask a crucial question to challenge all those massive billboards promising you 8 or 9% gross yields. For generations, the default financial advice has been buy property, the cash flow is passive. But look at the economic landscape of 2026. We've got elevated interest rates, strict lending, sky-high property taxes. So is it actually passive? Let's break down the math.
Now, this is where the hidden math gets really interesting. Imagine over 3 years you collect a seemingly healthy $17,000 in gross rent. That's the vanity metric, right? That's the number you see in the headlines. But then you strip away $9,000 in property taxes, $4,500 in insurance, throw in a little bit for maintenance and vacancies, and your net cash flow? It's shockingly small. You are left with a net profit of just $3,000 over 36 long months. Ouch.
And this brilliantly illustrates the reality for the independent landlord. Cash flow is rarely passive. It's actually a highly illiquid part-time job. A burst water heater at 2 a.m.? Yeah, that's on you. The roof needs replacing? That's on you. Your property is sitting totally empty for 2 months while you scramble to find a new tenant? You guessed it, that is on you too. You're effectively working a second job, but instead of a reliable salary, it pays you in equity. Which brings us to the wealth multiplier. Leverage. Despite all those headaches, we absolutely have to talk about the unfair advantage of real estate, because it's the exact reason this asset class creates so many millionaires. And that advantage is leverage. This is the superpower that allows you to use your $50,000 to control $250,000 asset. Think about that. You're capturing appreciation on the bank's money, not just your original cash. If your property grows by just 3 or 5% a year, that percentage applies to the entire $250,000 home. It makes the return on your actual out-of-pocket cash incredibly powerful. But we gotta be honest, leverage is a total double-edged sword. While it accelerates your wealth in a rising market, it works in reverse just as fiercely. Let's say you get a 5% property growth. Awesome, that translates to a massive 25% return on your initial $50,000 investment. But what if there's a simple 10% dip in the housing market? Your property just lost $25,000. Boom. You've effectively wiped out half of your initial cash down payment just like that. So what's the alternative here? Let's move over to the indexed fund advantage. If you really don't want a part-time job managing property, what does the mathematical alternative look like? Well, instead of putting your entire net worth into a single zip code, an index fund allows your money to compound quietly in the background across hundreds of top companies. And the best part? Near zero management effort. You aren't trying to pick the next breakout tech stock, and you definitely aren't paying some wealth manager a massive fee. You just buy a broad slice of the global or US market, and you let the overall economy do the heavy lifting while you focus on your actual career. And the absolute superpower here is total liquidity. This is a game changer for young professionals. If your life situation changes, say you want to move across the country, you literally click a button on your brokerage app, and you can have your cash deposited in your checking account in 48 hours. Compare that to the total nightmare of selling a property. We're talking months of waiting, massive agent commissions, endless legal fees. Index funds give you walkaway power. Okay, so the index fund path sounds perfectly stress-free, right? Zero leverage risk, complete liquidity, absolutely no tenants to deal with. But wait, what's the catch? We have to uncover the hidden costs that stock investors face, which real estate investors usually don't. Because look, if you aren't paying with your physical time and sweat, you are going to pay with something else entirely. Extreme market volatility. That is the gut punch of index investing. Sure, real estate values drop, but you don't have a glowing ticker tape in your living room showing you your house losing value every single second of the day. In the stock market, you do. Look at 2008. The market dropped 37%. Look at March 2020. It fell 34% in just a matter of weeks. That kind of drop, it requires incredible emotional discipline to watch your net worth plummet and just not panic sell. The strategy literally demands that you stay invested through market collapses, which, let's be real, goes against every human instinct we have. Which leads us to our final strategy, the house hacking cheat code. What if you didn't have to be just a landlord or just an index fund investor? Let's introduce a third path that refuses to choose between these two extremes. By house hacking, an investor can grab a property, like duplex, with minimal cash down. You live in one half, you rent out the other. Now, that rent covers the vast majority of your mortgage, your property taxes, and your insurance. But here's where the magic really happens in step 3. You aggressively pump all the money you would have spent on your own rent directly into the stock market. Your real estate is literally funding your index funds. When we follow this timeline over 20 years, we see a fascinating divergence. It is an absolute race. In the early years, the real estate investor pulls ahead, riding high on the power of leverage. But around year 7, the index fund investor's compound interest really kicks into gear. The gains on their gains start generating serious momentum. By year 10, the pure landlord and the pure indexer are practically neck and neck. But our hybrid investor, the one running both the leverage engine and the compounding engine at the exact same time, they start rapidly pulling away from the pack. And after 2 decades, the results are staggering. The pure real estate strategy ends up around $400,000 in equity. The pure index fund strategy finishes near $411,000, so essentially a tie. But the hybrid investor who combined the leverage of property with the compounding of stocks, they walk away with nearly double the wealth, sitting at approximately $765,000. They use the exact same starting capital, but they refuse to treat the decision like a totally binary fork in the road. Ultimately, there is no guaranteed winner between just real estate or just index funds. Your choice really just depends on you. Do you want a highly leveraged part-time job that requires fixing toilets and managing tenants? Or do you possess the sheer patience and emotional discipline to ride out the stock market's violent storms? Because you have to pay the toll one way or the other. You either pay for your wealth with physical sweat or emotional discipline. So, knowing what it takes to actually build wealth in 2026, which price are you willing to pay?